Yes.
Okay. So see, multi-stage growth is nothing but the growth here you are going to see not at one single rate, but more than one rate, you will be seeing the growth of the dividends happening. Okay. So the dividend is going to grow at two different rates. Initially, it is going to grow at some X%, and after a certain period of time, it is going to grow at Y%. Okay. So consider a stock with dividends that are expected to grow at 15% per year for the 2 years, after which they are expected to grow at 5% per year indefinitely. So you understand that for 2 years it's going to grow at this, and after that it's going to grow at 5%. The last dividend paid was $1, and this is the dividend which was paid at the last, like before, and the cost of capital is 11%. That is cost of equity. They're asking you calculate the value of this stock using the multi-stage growth model. So for calculating the value of the stock, the concept is present value of future cash flows. Okay. So first we need to understand what are our future cash flows. First, dividend for the first year, that is at the end of the first year, dividend which was paid at the last, like previous dividend, you will say it as previous dividend, into the growth factor is going to give you the dividend at the end of the first year. Then you take that dividend and again apply the growth factor. You are going to get the dividend at the end of the second year. After getting dividend for the 2 years, you can find out the dividend for third year also. Okay. Why am I finding the dividend for third year? Because after that it is going to grow at a constant rate of 5%. So the dividend I'll take for the second year, because I'll show you why I'm doing this. The dividend for third year is nothing but going to be like the dividend for the second year into 1 plus growth factor of 5%, the constant growth, okay, which is going to give you the dividend 1.386. Okay. Now I'm going to take this as my future value. Yeah, so present value of future cash flow. So the future cash flow here is D3, the dividend for the third year, okay, or at the end of third year. I'm going to discount it at the cost of equity, which is 11% by subtracting the growth factor, growth rate. We have already discussed about this formula, and you're going to get the value of the stock at the end of the second year. Okay. So the reason for calculating the third year's dividend was to take that as my future cash flow to find out the stock at the end of year two. Now I get stock price at the end of year two. I'll take that, and also, I'm going to get the dividend at the end of year two as 1.32. These are two cash flows. One is the stock price at the end of year two. Sorry, stock price is this. One is the stock price at the end of year 2 and one is the dividend at the end of year 2, D2. And then I'm going to discount it at the rate of 11%. That is 1 plus 0.11 whole square. And I'm going to take the stock price at the end of year 1, and I'm going to discount at the rate of 11%. Okay, this cash flow's present value is going to give me the stock price. Okay, so this is the way you find out the stock
Sir,
price with
screen is
by
not
taking
visible.
multi-stage model. Sorry,
Screen is now not visible again.
not visible. Everyone is facing the same problem.
No, sir. Now it's
Hello.
visible in the screen.
Now it's
Okay. Please have a look through this question, all of you, and just have a look through this. If you got any, then I'll move forward. Okay. Next. Identify characteristics of companies for which constant growth or a multi-stage dividend discount model is appropriate. See, for which kind of companies this is appropriate is what they are asking. Let us discuss this question. See, Gordon growth model uses a single constant growth rate of dividends and is most appropriate for valuing stable and mature non-cyclical dividend paying firms. Of course, see, Gordon growth model is very ideal for some companies which are very stable, which have which have been into a particular business for a very good amount of time or a long amount of time. They have been in the same business. They are non cycle. See, the business cycle does not impact them a lot. Okay, that means they make certain products which are now have become wants for people, and they are like constantly paying the dividends. So for dividend paying firms with dividends that are expected to grow rapidly, slowly, or erratically over some period, followed by constant dividend growth, some form of multi-stage model should be employed. See, first in some initial years, the dividend is going to grow at some rate, but after that, it's going to take the constant growth rate. So for that, in that case, you can use the multi-stage model. Okay. So dividends must be estimable. That means you should be in a position to estimate that this dividend amount which you are going to receive in the near future, and also must grow at a constant rate after some initial. So constant growth model can be used to determine the terminal value of the stock. Terminal value is nothing but the value of the stock till the time you are planning to or you want to hold the stock. Okay, square goes to second year because like we are not taking the value after that. Okay, see, terminal value is ending value. Stock does not have a maturity date, so it only depends upon how many years you want to hold the stock. Thus, we can apply multi-stage growth model to a firm with high current growth and will drop to a stable rate in the future. So right now the question you saw 15% the dividend was growing and again it went for 5%. Okay. So depending upon the scenario and situation, you can apply the model for calculation of stock. Okay. So one variant of multi-stage growth model assumes that firm has three stages of dividend growth, not just two. These three stages can be categorized as growth, transition, and maturity. So growth is one which we saw. Transition is nothing but the period in which the firm is reaching to certain heights. Okay, and then it has already reached a point from where it is not going to go much more higher. Okay, so that is maturity. So a three-stage model would be suitable for firms with an initial high growth rate followed by lower growth rate during the second transitional period, followed by constant growth rate in the long run. So I would like to say 15%, 10%, and then 5% constant. Okay, so It is what? When a firm does not pay dividends, estimates of dividend payments some years in the future are highly speculative in this case, and in any case where future dividends cannot be estimated. This is the point you should be noting down. With much confidence, valuation based on future cash flow to equity is appropriate, which we have already discussed in the previous session, as long as growth rates of earnings can be estimated. In other cases, valuation based on price multiples may be more appropriate, which we haven't yet done. Okay. So relative valuation measures, let us see the price multiple approach, how to value the stock. So I will explain you how to go about this. So calculate, and so they are discussing about price multiple. Okay, price multiples are what? Price multiples are, there are four price multiples here we are going to consider to value the price of a stock. So in all the cases you see here, price to earning ratio, price to sales ratio, price to book value ratio, price to cash flow ratio. Price here means market price. Market price by EPS is equal to, if you have this ratio, let's say this is 10 or something, you multiply EPS with this figure, you get the market price. In the same way, market price by sales is equal to, have some value for this, let's say 10. You multiply this to selling price per unit, it should be, okay, sales per share. Okay, sales per share. Here per unit I said, so that unit is nothing but one share. Okay, one share is equal to 1 unit I'll be considering. So per share, sales per share they are saying. Okay, if you are holding one share, let's say the sales of the company is 10 lakhs and there are 1 lakh outstanding shares. So on one share, the sales is going to be $10. Okay, then comes price to book value ratio. So market price by book value of a share is equal to some, you will be having, they'll be giving some value here, let's say it is 5, and book value is, let's say 20. So if I just take up that place, 25 are 100, you'll get the market price. And then price to cash flow ratio, that means cash flow here is cash flow per share again. Okay, so these are the four multiples. Let us take some questions and solve. First, we are taking the multiple based on fundamentals. So to understand fundamental price multiples, consider the Gordon's growth valuation model. This is the formula for Gordon's growth valuation model, whereby we are taking the price and then dividend by cost of equity minus growth factor. Now I'm going to divide both sides with earnings. So if we divide both sides of the equation by next year's projected earnings, we get this. Okay. So price to earnings, fine, which is the leading PE for this stock if it is valued in the market according to constant growth dividend discount model. Leading is nothing but the upcoming. So this PE based on fundamentals is also referred to as justified PE. So we have, taken the earnings and divided, okay, and, price to earning and dividends to earning, okay, and then discounting this cash flow with cost of equity to get the present value. Okay, so, when you discount this, let's say your dividends are $10, your earnings are $100. So, on earning of $10, you have a dividend of $1. Okay. So I can take 0.10 as well and I discount it. Okay. And then I know the earnings and I can just cross multiply. I can get the share value here. Okay. So this PE based on fundamental is also referred to as justified PE. Why justified PE? It is justified because assuming we have the correct inputs for dividend, next earning, the discount factor and the growth. So the previous equation will provide a PE ratio that is based on the present value of future cash flows. As I said, here you have the future cash flow in the form of dividends and earnings. You are taking the ratio of that, so you are discounting it, and then you are getting some value here. You cross multiply earnings, you get the price of the stock. So we refer to this as leading PE ratio because it is based on expected earnings of the next period, not on the actual earnings for the previous period, which would produce a lagging or trailing PE ratio. Okay, so this is justified PE or leading PE ratio because it is based upon the future expectations or future expectations of the earnings rather than the previous ones. Okay, the previous one would be called as lagging or trailing, and the future one will be called as leading. Okay, so this is the concept, and based upon this we are going to do a question. Please solve this question, all of you, please do this. Find out the expected PE ratio. So a firm has an expected dividend payout ratio of 30%. So a required rate of return of 13% and an expected dividend growth rate of 6%. Calculate the firm's fundamental justified PE leading PE ratio. So we have to find out this one. So how to go about this? So you will take what first? So we will take this dividend payout ratio. Dividend is always paid out of the earnings, right? Dividend is always paid from the earnings. So D1 by E1 expected dividend payout ratio. So dividend payout ratio is given to us 30% divided by the required rate of return is this and the growth factor is this. If you remove, you get the expected PE ratio. Okay, please calculate this one. We'll move forward. So the justified PE ratio serves as a benchmark for the price at which the stock should trade. Okay, we have also seen the concept in the previous session whereby we were looking at how to find out the intrinsic value of a stock, and then we were checking the undervaluation or overvaluation of the stock in the market, and based upon that we were taking our decision whether to go for short selling or whether to go for buying the stock. So in the previous example, if the firm's actual PE ratio was 8, then the stock would be considered as overvalued. If the firm if the firm's previous if the firm's market P ratio was 2, the stock would be considered as undervalued. Okay, so that's what they are saying. You can compare the justified PE ratio serves as a benchmark for the price at which the stock should trade. Let's say here this is the this is 4, and we will see the stocks, the P ratio above this and below this. This is the expected PE ratio. So if the firm's actual PE ratio based upon market price and earnings was 8, so if it is 8, the stock would be considered as overvalued. You can do short selling. And if it is 2, that means the stock is undervalued. You can buy and hold and see for the time where the stock, like the correction goes in the market and stock reaches the price which you have estimated, and then you can sell and you can book your profits. So this is your justified PE. Above this, any stock, if above this, if the actual PE ratio you calculate, or if you calculate actual PE ratio and it comes above this, then definitely the stock is overvalued. And in this case, the stock is undervalued. So because we started with the equation for the constant growth dividend discount model, the P ratio calculated in this way is P ratio consistent with constant growth dividend discount model. We can see from formula that other things equal, P ratio we have defined here will increase with higher dividend payout rate. See what happens if your numerator increases. They are saying if this one increases, of course the P ratio will be high. And perception wise also, more dividends, more higher the value of the stock is going to be. So in either cases, so with higher dividend payout rate, higher growth rate, a lower required rate of return. Okay, so we will see all the 3 points. If the dividend is higher, the numerator is higher, the ratio will be high. If the cost of capital is less, the ratio will be high because denominator is less. And the growth factor, if it is, see if 10% is the cost of capital, growth factor is 5. You get discount factor of 5. If the growth factor is 6, if higher the growth factor, okay, the lower the denominator, the more higher the ratio. So in practice, other things are not equal. An increase in dividend payout ratio, for example, will reduce the sustainable growth rate. Yes, if more and more dividends are paid, then less is retained, and less is retained and less is reinvested. So it will disturb the sustainable growth rate of the company. While higher dividends will increase firm value, of course, the reputation of the firm will be more in the market, higher in the market, and lower growth rate will decrease firm's value. This relationship is referred to as dividend displacement of earnings. So the net effect on firm value of increasing the dividend payout ratio is ambiguous. So that is a matter of ambiguity, or a lot of confusion is there to come to a conclusion in that case. Okay. See, higher dividends are good for the company. Higher payment of dividends will increase the firm value. A lower growth rate will decrease the firm value. Okay. But higher dividend payout ratio will also impact the sustainable growth rate. So this is creating a lot of confusion in the mind of the investors. One side, increase in the dividend payout ratio is going to reduce the growth rate. Higher dividends is good for the investors every point of time. So as intuition would suggest, firms cannot continually increase their P ratios or market values by increasing the dividend payout ratio. Otherwise, all firms would have 100% payout ratios. If that is the case, every company will pay the highest dividend and try to increase their value. But that is not going to happen, because the price to earning ratio is nothing but market price by EPS. Yeah, one way we calculated was the expected earnings, the future expectation of earnings what you had. So they are saying if the firm looks at increasing this P ratio by increasing the dividends, so they can do it to maximum 100%, but that is not going to always work out for the company. Very high dividend payout ratio is again dangerous for their sustainable growth rate. Sustainable growth is nothing but they have to survive, right, for a longer period of time. If they give the entire payments of the entire money, whatever they have earned as dividends, and what are they going to retain, and what are they going to reinvest, and how are they going to save the cost? So now fundamental PE ratio comparison, please go through this. We'll discuss. So fundamental PE ratio comparison, Halt Industries makes decorative items. The following figures are for Halt and its industry. Dividend payout ratio, Halt Industries 25%, industry average 16%. So see, the dividend payout ratio is more for Halt and the industry average is 16. They are giving more dividends, it seems. Their sales growth is also very high. Industry average is less. Their debt to equity ratio is also very high. They are using very high debts. Okay. And the industry average is just 68%. That means in the entire the industry from which the Halt Industries come. Okay, Halt Industries company or firm which is a part of some big industry. There the regularly the capital structure is not is what we are seeing here. Like, okay, the debt is used very less when compared to the debt what Halt Industries is using. So what is that they are saying us to see here? Which of these factors? Just a second. So which of these factors suggest a higher fundamental PE ratio for Halt? So see, the PE ratio will be high in what cases? First of all, the higher dividend ratio supports Halt having a higher PE ratio than the industry. Why? Because the dividend payment is high. The dividend, if I take a numerator which is very high, if the numerator is very high, the ratio will be high. More dividends are also going to increase the PE ratio. Why? Because people, people's sentiments and people's perception is that if a firm is paying high dividends, its share value is going to grow or going to increase very high in the coming future. So in that case, again, what will happen when the market price of the share increases, the PE ratio will be high. Either way, I have explained you. Okay, one is through the equation what we saw, and one is through the perception. Higher growth in sales suggests that Halt will be able to increase dividends at a faster rate, which supports Halt having PE ratio higher than the industry. Of course, more revenue, more profits, more dividends. Higher level of debt, however, indicates that Halt will have higher risk and higher required return of equity. Yes, as the risk increases because of the debt, the cost of equity, that means the equity holders of the company will demand for higher returns to compensate them for taking a higher risk to continue in this company. So with the higher discount factor, more discounting will happen, and that will reduce the PE ratio. Okay, higher discount factor, okay, lower PE ratio. Please make a note of all this. Please have a look through this. We'll move forward. Any doubts, please ask. I'm waiting. All of you following?
Yes.
Yeah. Okay. Multiple based on comparables. Let us go ahead and see valuation using comparables. Okay. So the following figures are for Reni's Bakery. All figures except the stock price are in millions. So except the stock price, this ones all are in millions. Okay. So they are asking you to find out the Rini's lagging. Calculate Rini's lagging price to earning, price to cash flow, price to share, and price to sales per share, and price to book ratios. Judge whether the firm is undervalued or overvalued using the following relevant industry averages for 2003 and firm's historical trend. See, why don't you do this? You can find the data is given. Calculate Rini's lagging ratios. Judge whether firm is okay. These are the actual ratios. You calculate the Rini's ratios. Okay, so once you calculate the Rini's ratios, then we will see what to be done. Okay, first, can you calculate for the years? Basically 2003, 2002, 2001. So these four ratios you need to calculate. You know how to calculate, right? So I'll do the first one for you. Price to earning ratio. Price. So market price. So stock price 11.40 by EPS, earnings per share. So how will you find out earnings per share? 3.2. This is 3.2 million divided by outstanding shares 4.476. Just tell me what is the answer there you're getting. Hello, I'll do it for you.
Yes.
You'll get 0.714. So 11.40 divided by 0.714, 15.9 or 16 something you'll get. Yeah, the price to earning ratio for 2003 is 15.9. Like that, you can calculate the ratios of all the years. Okay. So price to earnings I have done for you. Price to cash flow. So all is per share, right? Cash flow from operations is given 17.90 divided by the cash flow is how much? No, outstanding shares 4.476. That is 3.9994 it seems. So price 11.40 divided by 4. 3.99 and something 2.85 I'm getting. That is price to cash flow. Okay. Okay, 2.9 something. Okay, I got the same thing. Then price to sales. So your like market price is 11.40 sales. Your sales is this divided by outstanding 77.30 divided by 4.476, 17.2. Net revenue by share, also sales per share. Zero point 0.66 only. So 0.7 almost. I got the same thing. And the last one, price to book. Price is 11.40. Book value. Book value shareholders equity by outstanding shares. 12.42. 0.917. 0.917. Okay, so all the 4 years ratios you find, please, and then we'll see the comparison. Comparing Rini's Bakery ratios to industry averages, for 2003, the price multiples are lower in all cases except for PE. So we'll write the ratio here: 8.6, 4.6, 1.4, 3.6, 8.6, 4.6. Then 1.4, 1.6. So the price multiple, price to earning ratio is high and others are very less. Okay. This cross-sectional evidence is that Rini Bakery is undervalued. So what we did is, uh, like, these are the industry ratios. Price multiples are lower in all cases. Okay. The cross-sectional evidence suggests that Rini Bakery is undervalued. Why it is undervalued? In all the cases, it is less. Okay. Except the one case. Fine. So the P ratio merits further investigation. See, in all cases, it is less, right, from the industry average. So it is undervalued. If it is more, overvalued. Yeah, just a second. Yeah. So the P ratio merits further investigation. Rini Bakery may have a higher PE ratio because its earnings are depressed by high depreciation. Okay, that is their expectation. See, earnings may be, see P ratio. What happens? The earnings, if it is less, because dividends by earnings, right? If the denominator is less here, then what happens? The ratio will be high, of course. Earnings are depressed by high depreciation, maybe high interest expense, the earnings may be less, or more taxes. Calculating the price to EBITDA ratio would provide, EBITDA is nothing but before interest, tax, depreciation and amortization, will provide an alternative measure that is unaffected by these expenses. Maybe they are saying that the earnings may be very less because of all this. Otherwise, if the earnings are less, the denominator is less, the ratio will be high. On a time series basis, the ratios are trending downwards. This indicates, so yeah, ratios are trending downwards. If you see, from 2001, the ratio has decreased, and again from 2002, the ratio has decreased. Every time it's happening the same. Except in the one case where the ratio has gone high and gone down, but it is always decreasing. See, you can check, it's decreasing. So this indicates Rini's Bakery may be currently undervalued related to its past valuations. If the ratios are decreasing, it is undervalued, right? We could also calculate average price multiples for the ratios from 1 to 3. So they have done the average. And and you see on average what are their ratios. The current price to earning, price to cash flows, price to book are lower than 3-year averages. Let's see the 3 years average. Yeah. So these are the industry averages, 8.64. Okay. And we also saw the, okay. So what are they saying here? The current, these three ratios, P and price to cash and this are lower than their 3-year averages. So we see the current ratios, right? 15.9 and this. Okay, 15.9, 2.9, 0.7. 15.9 is less and 2.9 is less and 0.7 is less. Only this is more. So this indicates Zenith Bakery may be currently undervalued. It also may be the case, however, that P ratios for the market as a whole have been decreasing over the period due to systematic factors, which we cannot do anything, right? Because systematic factors are the one which are like, which is the one which we do not have any remedy, okay, to control that, because everyone is suffering because of those factors. It is systematic risk. Okay, so today let us conclude this till here. Tomorrow will be the last class for this chapter, equity valuation. We have one topic to do, that is enterprise value and some theory. Tomorrow I'm going to finish this chapter for completely. Okay, so let's connect tomorrow. Thank you all of you. Good night.